After taking a few days to analyze last week's jobs numbers, if you're left a little confused, you're not alone. On the surface, a jobs report gave us a lot of reason to celebrate. Blowout May jobs data closes the door on a July rate cut. The U.S. labor market showcased its resilience in May with non-farm payrolls surging by 272,000, far surpassing the anticipated 180,000. But almost in the fine print, this robust increase occurred despite the unemployment rate inching up from April's 3.9% to 4%. So the non-farm payrolls goes up, but the unemployment rate also goes up. What's going on here? The non-farm payrolls, that's a total number of jobs added. We can see the non-farm payrolls was reported at a rate of 272,000, far surpassing the prior month's 165,000. Then we have the unemployment rate. That's the percentage of the labor force that is actively seeking employment. The unemployment rate was reported at a robust 4%, surpassing last month's 3.9%, and in fact, the highest high we've seen in several years. Certainly not a good sign. So, there are several reasons why the non farm payroll number and the unemployment rate could go up together. We could talk about timing. Non-farm payrolls is more reactive to short-term changes in the labor market. It reflects economic shifts like job creation or layoffs, whereas the unemployment rate, it tends to be a lagging indicator, influenced by labor force participation rates and demographic changes. But we can dig deeper than that. We could talk about the possibility of more job openings. If more people enter the workforce, the unemployment rate will go up and the non-farm payroll report will go up at the same time. The reason being, more people enter the workforce. They do not yet secure jobs, so the more people and there's still open jobs, the unemployment rate will go up. At the same time, maybe some of those people actually get a job. On the short term, the non-farm payroll will go up. Did that happen? Well, here's the job openings. This is from the JOLTS reports. This was reported in 8,059. This is the lowest low we've seen in several years. Certainly, job openings are not on the rise. Are more people in the labor force? Not according to the labor force participation rates. That's at a level of 62.5%, below last month's 62.7. So, is this the case of more job openings, more people entering the labor force? That's a negative. We could talk about discouraged workers. Those are the people that have given up seeking employment, and maybe some of them re enter the labor force when they perceive better job prospects. This can lead to an increase on the short term of non farm payroll and on the long term on the unemployment rates. Did this happen? Well, to answer that question, we have to talk about the difference between U3 and U4. What is U3 and U4? U3 is a standard unemployment rate. That's what we all talk about every month. This month, 4%. U4 is that standard unemployment rate, U3, plus the discouraged workers. Well, this is U4, including the discouraged workers. That's at a level of 4.2%, surpassing last month's 4.1%. Again, in fact, this is the highest high we've seen in quite a while. How does this compare to U3? U3 is shown in blue. U3, again, is a standard unemployment rate that we talk about every month. U4, including the discouraged workers, is shown here in red. Well, including the discouraged workers, we're at a level of 4.2%, higher than the standard unemployment rate of 4%. So we certainly can conclude that including discouraged workers, the trend is accelerating to the upside. So what can we conclude from this? Is this a case of more job openings, more people entering the labor force? Negative. Is this a case of the overall trend, discouraged workers leaving the workforce? I think we could say so. But to what degree? Well, we can see here in blue, that's a labor force participation rate. In red, that's the unemployment rate U4, again, including the discouraged workers. And this is probably the most troubling part of the reports. Notice overall the labor force participation rate, yes, it did decline. That is the case from last month. But more or less, for the past year or so, it has held steady, at least the average has. Whereas the unemployment rate, including the discouraged workers, that continues to rise. So, and there are other measures. Again, there's temporary work that will enter and leave the workforce as well. But what's most troubling is that every month we seem to see a greater number of discouraged workers leaving the workforce. And this certainly is not a good omen. This week's economic calendar, we hope it will be a better omen. It includes the CPI, Consumer Price Index, the Producer Price Index, two major inflation rates, in addition to a very important Federal Reserve decision. And on the basis of these reports, the Fed decision especially, this could certainly go to influence the financial markets and the trends that we may see for the remainder of the year. We hope this has been helpful. We look forward to seeing you back soon.